Hello, Startup Vision. I'm Romain Serman, the head of Bpifrance here in the United States.
Hello, Romain. Thank you for being back on Startup Vision TV. So Snowflake had the biggest software IPO ever in September, and we're so proud of it. And Romain, remember when we last spoke, it was the beginning of the crisis. So today, where do you think we stand in terms of investments and in terms of the dynamism of the ecosystem?
You're talking about the ecosystem in the US, right? Or in
Right,
France and Europe as well?
in France.
That's a good question. I think, yeah, the last time we spoke was probably end of March, something like that.
Yeah,
So we were,
something like that, beginning of April, yeah.
yeah, so it was just beginning of the crisis of the pandemic. At the time, I remember well, everything stopped actually. At all levels of investment, from seed to late stage, especially late stage. It's super hard to invest 5, 10, $20 million on a Zoom. So it was very hard. I think that very quickly, probably since even the end of April, you've seen the investment activity going back up again, especially at early stage, which means pre-seed, seed, and even Series A's. For the same reason, because it's pretty easy, to cut a check of $1 million or 500K on a Zoom. That's possible. And actually, investors learned how to do that, funders as well. So since the end of spring and throughout the summer and right now, especially in the US, we've seen the investment activity going back up again. At early stage, seed and Series A mostly, the activity is really good right now in terms of volume, in terms of deals made, and in terms of dollars invested, even if it's a little bit less than last year, but still the activity right now is really good. And I would say that since the end of the summer, at late stage level, we've seen the investments going up again at late stage. So I think we will end up at the end of the year with almost the same level of investments as compared to last year, 2019, which means in the US around 10,000, 11,000 deals, something like that. And in dollars, probably around $120 billion invested this year. So the conclusion is there is a slight decrease, but it's not really a crisis in the investment industry.
It's very impressive. And is Silicon Valley still the heart of the startup ecosystem, or do you see other places in the US with a strong ecosystem also?
I've heard for years now, people saying, it's the end of Silicon Valley, blah, blah, blah. The answer is no. So I answer, directly to your question and very fast. I think that, you need a lot of ingredients for the recipe, to build up a very strong and efficient ecosystem. But the main one, to me, is the density locally, the density of experienced people. In mathematical terms, I would say that the quality of an ecosystem is a function of the density of a network of experienced people. And the thing is that in Silicon Valley, this is where you have the highest number of not only smart people, it's not the point, the highest number, the highest density of experienced people. It means founders who have already built 2, 3, 4 companies. It means CROs, people in charge of sales who have already scaled twice, 3 times, 4 times companies from 10 million ARR to 100 million ARR. It means the density of people who have done marketing in B2B, B2C for 20 years. It means, CTOs who have already led 3 times in a row large engineering teams, etc., etc. Starbucks are open right now. So in San Francisco, if you go to a Starbucks and you just yell, "Hey, I need, a CMO with a lot of experience," you will have like 4 or 5 people raising their hands. So for that reason, density of experience, I don't think that Silicon Valley will fall. That's my point. Now, it's true, and you're absolutely right to say that there will be new or other metro areas, other hubs that will emerge. It's already the case. By definition, for a long time now, you have already New York and Boston, of course. It's done because they have this density of experienced people. But I strongly believe that you will have few other hubs. I don't think you will have like dozens of new, in the US, dozens of new ecosystems, but you will have few more. I'm thinking of Los Angeles for sure, Salt Lake City, Seattle, maybe 1 or 2 others like Austin, more or less, but and that's it. You won't have like 15 super dense, super strong ecosystems in the US. For sure, now you have the Silicon Valley, you have New York, Boston, and you will have more and more LA and Salt Lake City, I think.
And do you see new forms of investments appearing and thriving in the future, like solo capitalists, for example, or others?
Yeah, I love this question because it's true that you have new trends in the investment industry right now. When I say new, it means for the last probably 2 to 3 years. So it's new. I see 3 or 4 new trends. Number one, that's a big one, operators. Operators are, founders, CEOs, all the C-level people, CMO in marketing, CRO in sales, etc., etc. The trend is that founders, especially at early stage, right now they prefer having experienced operators on their cap table rather than institutional VCs, because they bring much more value, I have to say. You have some VCs that can bring some value, but operators is the best. So what you see now is founders, especially at seed level, even Series A sometimes, really looking for operators that could, cut checks of 500K or even $1 million, because you have more and more operators that get rich thanks to their previous exits. So operators, it's a huge trend. Operators on cap tables, especially operators that can cut big checks. Second trend, the SPACs, special purpose acquisition vehicles. The problem is related to the problem of the IPOs. You have IPOs, everyone is happy because at the end of the day, you have what we call a bump of the stock price. But actually it's totally stupid because a bump means that the company has left tons of money on the table. IPO is, the main goal of an IPO is to raise funds. So when you introduce your company with a stock price at $20 and at the end of the day it's $60, it probably means that you could have sold your in the morning you could have sold your company for $60 a stock, which means that you have left a lot of money on the table. So the main advantage of SPACs is exactly this, allowing companies to raise what they can raise when they become public. So a SPAC, it's actually an empty shell, a company that has no operations at all, and this company does an IPO. By doing an IPO, the SPAC raised funds, and thanks to these funds, they have 2 years to acquire a company. By definition, this company, and then they will merge, so this company will be traded on the public market. SPACs is a big, it's not new, but today it's a big trend. It means that you will have a lot of companies that will use SPACs to go public, meaning they will use SPACs to raise a lot of funds. The third trend I see, it's a little bit of legal stuff, but you have some big VC funds, especially in the Silicon Valley, that changed their legal status. In the past, they were venture capital firms, which means that they can do venture capital. It means that they cannot do a lot of stuff. They cannot trade public stocks. They cannot provide debt to companies. They cannot invest as a fund of fund, for instance, or they could, but you have to change a little bit of their what we call the LPA, which is the agreement among their own investors. And in any case, it's limited. They cannot, or they can do a little bit of secondary market, meaning buy and sell stocks to funders or fund funders, etc., etc. So you have now large VC firms with $1 billion, $2 billion, $3 billion under management that change their legal status to what we call, sorry, it's a bit technical, but to what we call RIA, which means Registered Investor Advisor. What it means is very simple. It means that they have raised capital from their own investors, and with that, they do whatever they want. They can trade public stocks. They can do LBOs. They can trade on secondary markets. They can invest as a fund of fund, and with no real limits. If they want to invest 50% of their capital into public markets, they could. So this is another trend, which means some VC firms, they want to have more freedom in their operations, and it could be a big trend. The last one, sorry, I'm a bit long, but it's a big question actually. For me, the last one, which is key, is what I call the data-driven funds. My point is, I strongly believe that 10 years from now, if you're an investor, and if you are not augmented, I would say, by software, kind of AI, you will lose the competition. Hedge funds today, which to me are the smartest guys in the market, hedge funds for years and years and years, they've been using software data a lot to trade their deals. I would say it's the easiest part, because when you trade public stocks, you have a lot of signals, and most of the signals are public. So I would say it's pretty easy. It's hard, but it's pretty easy to use the software to capture and analyze the signals to invest or divest. If you do growth venture, it's also possible. You have a lot of signals. For example, you check a website of a company and you want to invest $100 million in this company. It's already a mature company. You just count the number of logos they have on the website. You have an idea of the number of customers they have, and you compare that in time. My point is, it will come to earlier stage. For Series A and even seed, even pre-seed, you will have more and more, not a lot of, but more and more funds or funding teams in the venture industry that will use software to do their job, to source deals, so to find the best teams or to find the best opportunities. It could be, based in New York, and thanks to the software, they could use the best Malaysian company in Malaysia or in Brazil without even being there. They will use software as a selection tool. How do you know who are good and who are bad? Right now, what you do is just, you talk to the founders and you have kind of a gut feeling or some data, just a little bit. But I think that AI and software will be used massively to improve the investment operations in the future.
So other changes, in the 2010 decade, we saw growth as the main KPI. What will be the next KPI, and what has changed for the next decade?
So, good question. Again, you just asked good questions. Crazy. The venture industry, it has a model. When you set up a VC firm, usually it's for 10 years. You could have an extension of 1 or 2 years, but it's for 10 years, which means that the VC model financially only works with hypergrowth. You cannot invest as a VC firm in a company and waiting for 20 years before something good happens. You cannot do that. That's not the model of the venture industry. So because of the structure of the VC model, which means the 10-year model, growth will always remain the main KPI, hypergrowth. If you want to invest as an investor in a company that bootstraps or that operates in a sector that will take a lot of time for a potential big outcome, it's not for venture industry. It's not for a venture investor. It could be for other kind of investors. So growth will remain the key KPI. This said, I think that profitability will be more and more considered in any VC investments. As I said, I think last time, we've seen over the last 4 or 5 years, tons of investments in companies that never became profitable. And that's a problem. So growth will remain the main KPI, and profitability of companies, which means unit economics, capacity to make a profit someday. This will also become a very important factor for investors.
Thank you so much, Romain, for sharing all this once again with us on Startup Vision TV, and we hope to have you back very soon. Thank you.
Thank you, Florence.